The question is the next Governing Council, which will be early June the 6th. By the way, it will be the 80th anniversary of D-Day, but this is by chance. And here, bearing a major surprise, I think we should cut rates because we are now confident enough and increasingly confident about the disinflationary path in the euro area.
Were you hoping, though, that the ECB would take an insurance cut in April? And if so, did you miss a window to go earlier with rate cuts?
Again, April belongs to the past. We had an intense discussion and an open one about the economic situation. And there is now a very large consensus that it's time to take this insurance, more or less, against what I would call the second risk. The first risk is to act too early and to let inflation go upwards again. And this would be a danger. But the second risk would be to be behind the curve and to pay a too high cost in terms of economic activity and employment. What I say, and I think what the Governing Council says, that these two risks are today at least balanced. So it's time to take an insurance against the second risk. And we will still be in restrictive territory. This is important. You know that the border between accommodative and restrictive is a so-called neutral rate, R star. Nobody knows exactly where it is because R star is not measurable.
Where do you think it is, though?
Our best estimates for the euro area are between 2 and 2.5. So we still have ample room while remaining in restrictive territory to ease and to cut rates. After this first rate cut, we will monitor inflation data, be they actual or forecast, and the forecast is very important, and we will adapt the pace of our next rate cuts, because there will be others, and the final destination.
What could get in the way of a June rate cut, which is well and truly teed up now, and further rate cuts? Is it still wages? Is it oil, geopolitical shocks? What are the wild cards here?
I said bearing a major surprise. So by definition, you don't know what a major surprise would be. But seen from today, I think it's a very plausible and reasonable scenario. It's a base case that we will cut rates.
Some Governing Council members are willing to commit to 3 or 4 rate cuts for the rest of this year. Are you also willing to acknowledge that it is feasible that we will see that many, 3 to 4?
We will follow really a data and outlook dependent approach and a meeting by meeting approach. So we won't give a forward guidance and I won't pre-commit today. But when we say meeting by meeting, it can be at each following meeting. I don't think, for example, that we should concentrate our rate cuts at quarterly meetings when we have a new forecast. It will be open. But let us be consistent. If we say we are data dependent, we are very pragmatic. I am an advocate of what I call a pragmatic and agile gradualism. It will be open at each meeting after June.
Inflation, is it coming back to target? And what is the risk if we have policy divergence from the Fed that some FX movements could actually undermine the journey back towards price stability, thanks to the strength that you might see in the US dollar versus the euro?
No, let us be clear about that, as Christine Lagarde was. As I just said, we are data dependent, and we are driven by our own data in the euro area. And we are focused on domestic price stability. We have no exchange rate target. So we are data dependent, we are not Fed dependent.
So the Fed has no impact, no bearing on you whatsoever?
No, we look at the situation, but I think that the business side, the general trend of the inflation surge 2 or 3 years ago and the disinflation in the last year was parallel. But we are not at the same level, we don't have the same business cycle, so each of our monetary answers should be domestic driven.
Do you think you are still battling inflation, though, or has most of the job been won so far, as you can see that 2% handle in sight?
The 2% target is in sight, and I want to repeat this morning that we will achieve it by next year at the latest, and this is a strong sign of confidence. That said, We now deal with services inflation mainly. Goods inflation has receded very significantly. Services inflation is still at 4%. So what we call the last kilometer on our side of the Atlantic, or sometimes the last mile, is not different in nature. We are confident it could be a bit slower.
What about growth? Because that's now rising to the top as a key concern, and we're seeing it even in France in terms of the government taking down its forecast for this year. We've seen it across in Germany, the so-called regional powerhouse of Europe, very fragile growth this year. Is there a concern of more growth slippage this year?
The good news is that we avoided recession. And remember, this was feared 18 months ago. So we will avoid both an installed a permanent inflation and a recession. That said, you are right, growth in Europe is insufficient. And this refers now to the need for structural reforms. We need to be more turned towards innovation, towards transformation. And this is precisely the aim of the so-called Letta report, Enrico Letta being the former Italian Prime Minister. And he's publishing today his report about the single market and its strengthening. And there will be very probably an endorsement by the European Council, which is gathering also today in Brussels. And I think this is very good news. We should unlock the growth potential in new fields like energy, telcos, and yes, finance.
We've heard these messages a lot over the years, over the past decade. A capital markets union is required, banking union, less regulation, rolling back red tape. It's been magnified in recent days by both Mario Draghi and Enrico Letta. How many more times do we need to hear this from senior policymakers in Europe before there actually is real action?
No, I think there are favorable factors, and let me quote two. First, we are coming out of the inflationary crisis, which completely dominated the political agenda in the last 2 years. So when inflation is receding, when the emergency is receding, it's time to go back to structural transformation. And second, we live in a different world. And this is the message number one by Enrico Letta. The single market was fought 30 years ago in a different world. Now we live in a more fragmented one, in a more volatile, uncertain one. And so it's time for Europe to implement its own advantages. Some call it strategic autonomy, take it as you want. But we have, in parallel with the US market, the biggest economic market worldwide, with more than 400 million inhabitants, which are rich, prosper. We have brains. We still have too many borders. So this is the message. If we want to use our full capacity, let us diminish these internal borders and be as attractive and as innovative as the US market. This competition is very stimulating for us and for our political leaders.
Do we still have too many banks in Europe? I mean, there's been a lot of soul searching on the back of the consolidation of UBS and Credit Suisse, talk about still banking union, whether we could see more cross-border mergers take place. Would bigger banks enhance the competitiveness of Europe?
Can I only remind you that UBS and Credit Suisse were not in the EU and in the euro area, and it was very specific. If you look at the banking sector in the euro area, it's much more solid than 10 years ago due to the single supervision, and this was the progress of banking union. But you are right, we need to have still more cross-border mergers. And beside a deeper banking union, we need what we call a capital markets union, or what Enrico Letta calls a savings and investment union. Because we have one resource in Europe, which is not very often mentioned, this is private savings. And it's up to 2% of GDP, excessive private savings, which we can use to fund our green transformation and our digital transformation. So you see, this is a consistent package. We must have a more powerful and more integrated single market, succeed in our two transformation, green and digital, and fund it through our own resources, which is this excessive private savings.
Let me ask you then about monetary policy as we look to wrap up, because it's clearly front and center for a lot in the markets. What do you think the pace of rate cuts should look like for this cycle? How is it different to the past? Because we're talking about competitiveness, we're talking about geopolitical events, we're talking about the potential for more shocks to come. Is this cycle any different to what's transpired in the past as we talk about cuts?
Clearly, Karen, I think it's too early to tell. But referring to all these elements you mentioned of uncertainty, this is one reason more to be data-driven and to decide meeting by meeting. It doesn't mean that we won't give short-term orientations, yardsticks to the markets. But I think the time of precise forward guidance, long-term committing, not being state-dependent is probably over. And we saw in the past when we had a very stable economy and a very stable world, it was probably easier. But now we have to be very pragmatic and agile.
The anomaly here has been wages, and we've seen that not just in Europe, we've seen it in every major economy, we've seen it in emerging markets as well. When do you think we start to see the balance tilting again, that the labour market weakens, whether it's AI, whether it's a change in immigration, whether it's a change from employers, capital markets? When do you think that changes in any decent way that has an impact on policy?
What we have seen in Europe is a significant improvement in the labour market in the last 15 years. And this is one explanation for what we saw. We saw the economy slowing down, rates going up, but the unemployment situation not deteriorating much. And this is a sign of a labour market which works much better. By the way, it's still more true in France, where we had significant labour reforms in the last decade. For the month to come, what we will see is that real wages will again increase, because the deceleration of prices will be faster than the deceleration of wages. And this is good news for consumption and purchasing power. This will accelerate European recovery. That said, about the future, I guess the main game changer would probably be AI. But on that field, I would be cautiously optimistic. As I said, Europe has to be more innovative, more Schumpeterian. Never forget that Joseph Schumpeter was born in Europe. He passed away in the US. But if I look at AI, it will bring significant increase in productivity and hence, in the long term, the quality of jobs.
When do you think we will see that productivity increase? Because I know some of the investment banks are starting to model it out. 2027 was one time frame I saw. It is a very swift innovation. I see that at all the technology events, from VivaTech in your country to Web Summit elsewhere in Lisbon. You are seeing much greater adoption than in the past. Do you think there are economic consequences? Does it show up in the economic modelling much quicker than other tech cycles?
There will be, for sure. But if you look at the history of innovation, one simple law is that you very frequently overstate the short-term benefits and understate the long-term benefits. I guess it will be the same for AI. But one thing is for sure, Europe cannot lag behind in AI. And we have the resources. As I said, we have the savings, we have the brains, and we should develop startups and scale-ups. We are now very good in Europe to raise startups. We are a bit less good in funding scale-ups and developing them to the European and even the global scale. This must change with AI.
Just very finally, I've got a little bit of extra time, so I want to ask you about the fiscal position in France. We have seen that Bruno Le Maire, the French finance minister, blaming falling tax revenues for a miss on the budget deficit. It overshot to 5.5%. Rating agencies have responded, from Fitch, which actually downgraded the credit rating. Moody's, S&P are taking a look. Does France need to urgently cut spending?
The technical explanation for the bad surprise of last year, this 5.5, is indeed linked to tax receipts. And these were late surprises. So there is now a new, what we call stabilization program presented by the government. I think as simple as that, it's time to implement it. It will not be easy, but it's necessary. And in the economic landscape we describe, with a gradual recovery and probably monetary policy easing, this creates more favorable conditions for reasonable fiscal consolidation.